A 29-year market veteran is sounding the alarm about a devastating stock market crash as the Fed starts tapering and rising interest rates next week, effectively pulling its support out of the market. Jon Wolfenbarger, who runs bullandbearprofits.com and is a former investment analyst for Allianz Global Investors and JP Morgan, argues that the only positive thing keeping the market from falling over was support from the Federal Reserve, which is now gone. A few days ago, the Federal Reserve announced it will start reducing its asset purchases at double the pace originally planned and hike interest rates 3 times starting next week to fight rampant inflation. The Fed plans to taper its bond and mortgage-backed securities purchases by $30 billion per month instead of the previously stated $15 billion, meaning that its quantitative easing policies will be completely suspended by March 2022. The announcement came last Wednesday when Fed Chair Jerome Powell admitted that inflation had been more persistent than expected and that the central bank would accelerate its tapering process and push interest rates up. In a matter of minutes, stocks significantly dropped before they began soaring again, leaving many confused whether that reaction was a melt-up or a melt-down. Since then, stocks have steadily fallen, marking a downward trend that is just the beginning. The central bank's monetary policy has pumped an unprecedented amount of money into the market, while near zero interest rates helped to push stock valuations to historic highs and boosted consumer demand to the highest level in decades. But as inflation started to spin out of control, the Fed is being forced to roll back its policies and take action to combat rising prices, which is leading to the burst of all of the asset bubbles it has helped to create throughout the past 2 years. The short-lived rally seen on Friday was sparked by investors' overconfidence and also fear. Some investors are trying to inflate the bubble again in an attempt not to lose the enormous gains they had over the past 18 months, while others are actually considering the Fed flash taper as a bullish sign because they believe the economy will be able to stand on its own and the current 40-year high inflation will fade by itself. But that is far from the truth. As Wolfenbarger pointed out, the end of the policy typically is an indication of a poor future for stock returns and inflated valuations. This means bad news for investors, said Wolfenbarger during an interview with Business Insider. That completely eliminates the main bull case that I think most investors are relying on. The financial analyst highlighted that a perfect storm for stocks to suffer a big crash is looming on the horizon. There's the declining pace of money growth toward zero, which occurred before the 2000, 2008, and 2020 recessions and market crashes. At the same time, there's the rising 2-year Treasury yield and the Fed's tendency to follow it with the federal funds rate. It always leads the Fed. The Fed, I think, has to follow the market interest rate, Wolfenbarger explained. He added that if the Treasury rate was much higher than the Fed funds rate, the banks would be more inclined just to buy Treasuries instead of lending to other banks. And so then you would have liquidity problems in the banking system, which the Fed definitely cannot handle. In essence, this means that there's a high probability of a yield curve inversion, which is an alarming indication that a recession is brewing. Exceedingly high valuations increase the odds of a brutal stock market crash, since stock prices will have to sharply readjust to come back down to earth. At this point, the Warren Buffett indicator, which compares stock valuations to GDP, is at an all-time high, while the Schiller price-to-earnings ratio is at levels last seen during the peak of the dot-com bubble in the late 1990s. However, behind soaring valuations is an unsustainably bullish sentiment, which Wolfenbarger sees as a contrarian indicator. Given that the number of stocks below their moving averages increases by the day, that's a sign that the market is showing internal weakness and a reversing trend. On top of that, worries about the new virus variant are starting to intensify, and as the virus tends to spread faster during the winter, the situation may soon get a whole lot worse. In recent weeks, several countries have reintroduced movement restrictions, stay-at-home mandates, business shutdowns, travel restrictions, and lockdowns to prevent another virus outbreak. Now that's the same recipe that led to the market meltdown of March 2020, and any unwanted surprises may lead us to the same path. Wolfenbarger concluded by saying that the initial pullback will be of about 20%, but the Fed tightening will trigger a bigger sell-off that will make the market drop by an additional 60%. Similarly, Seeking Alpha's market analyst Rob Delat argues that the first burst marks phase 1 of the bubble collapse, and now we're headed to phase 2. In a recent article, Delat explained why so many investors are scratching their heads about what's going on in the stock market right now. Even though indices keep trading at all-time highs, a series of individual stocks are dramatically crashing. Here's the explanation, he wrote. The epic 2021 bubble, which I've been warning for several times, has already collapsed, he says. However, due to the very specific characteristics of a bubble collapse, the indices continued rallying. But as we enter phase 2, that's about to change. So far, 2021 has been an incredibly strong year for the market, but now we're witnessing dozens of stocks, particularly in the small cap space, which have crashed by 20%, 50%, or even 80% from their yearly highs. The market of stocks has clearly been much more challenging in 2021, Delat says. What we experienced in 2021 so far was the first phase of the collapse of this bubble, but there is more to come, he continues. The first part of the 2021 bubble burst began with the collapse of small cap and meme stocks. Delat believes that the recent downturn can be categorized as the second phase of the bubble collapse. Finally, I expect that the last phase of the bubble collapse, phase 3, to occur in 2022, he says, as the Fed officially suspends its market intervention. The first bubble to pop was fueled by a new wave of investors, mostly millennials who have no concern about valuations and see no problem in taking huge amounts of risk, the analyst explains. Some brokerage firms, such as Robinhood, did everything in their power to attract these new investors by easing their policies regarding high-risk practices, including buying with margin debt and playing with options. Many of those new investors still believe that these high growth rates are going to persist for many years. But Delat warns, following the herd by buying hyped stocks can be a very costly mistake, which I strongly discourage investors to do. This group of investors love to pour giant piles of money into extremely expensive hype stocks. But as companies started to release their growth reports based on real economic prospects, these hyped small-cap stocks have been hit by an outlook of little to no revenues in the near term. Some of them have fallen to record lows, such as Lemonade, which crashed by 74% from its highs. Virgin Galactic Holdings similarly crashed by 74%, while Skills Inc. and C3 AI both collapsed by over 80%. Calling the sell-off of these unprofitable, expensively valued hyped stocks was not just a wild guess. It's a common phenomenon in financial bubbles that the weakest chains collapse much earlier than the rest of the market, the analyst notes. During the dot-com bubble, the exact same thing happened. Several unprofitable, hyped small-cap stocks aggressively dropped in 1999, but it took until March 2000 for the general NASDAQ index to peak and then fatally crash. In the second phase, which is the one we're moving into, the downfall is going to be considerably more painful. It is in phase 2 that we will see growth stocks plunging to record lows while the tech bubble burst finishes its course. Most of the new investors thought that growth stocks provided similar potential with lower risks. That could be true if the economy was stable enough to support growth, but that's not the case right now. There are growth investors who say valuations don't matter. I respectfully disagree, Allianz says. This year, the amount of money that went into these stocks was so mind-blowing that many of them gained hundreds of percentage points. As a consequence of valuations having grown to unsustainable levels, these investments became extremely risky as well. As valuation risks became unbearable and macroeconomic challenges increased, this asset class started to sell off significantly in November, he wrote. From that point on, we began moving towards the second phase of the bubble collapse. The phase where overvalued mid-caps plunged, Allianz cautions. Investors need to be aware of the possibility that these stocks will crash in the coming weeks and will need many years to recover to today's levels. All signs are pointing to an imminent disaster, or as Wolf Richter from WolfStreet.com has put it, this market doesn't need more alarm bells. They're already clanging and jangling all over the place. This extremely overvalued stock market is currently capitalizing on an economy that might exist by the year 2060, but not today. Leverage is starting to fade as companies report their declining quarterly earnings, and Fed tapering is only the tip of the iceberg for the stock market. Many problems are lying under the surface, and the truth is that the financial system is terminally broken. At this point, a stock market crash is not only a matter of logic, but of gravity. Buyers, beware.